Good afternoon. I'm Martin Armstrong, and we're going to look today at gold. We can see at this stage in the game that gold has been dropping rather sharply, especially after India has raised tariffs again in early June in order to stop the importation of gold, causing dramatic changes in their current account deficits. But cyclically, we're looking at any time a market goes up for about 13 years, we typically get the 2-year to 3-year correction process. It's possible gold could continue down for a maximum of 5 years, which will bring us into 2015. Nevertheless, even if we were to get a final low or a double bottom in 2015, the bulk of the decline should occur at this point, and we're looking at the low coming in perhaps here, the majority of it, at least 90% of the decline, should be finished by the early summer here of 2013. It's possible to extend into early 2014, ideally around January, but we'll look at that a little bit later on. We'll see here that gold has been moving down quite dramatically. Now, if we swap over to the monthly level, any market that we're going to look at has to move effectively according to what everyone is doing on a global basis. This is our real primary problem that we have in analysis. Everyone tends to look, including the government as well as the commercial analytical community, at domestic issues exclusively. So the Federal Reserve, QE1, QE2, the reason they failed to produce any real inflation is that the global economy that we're in today is far more dynamic than anyone suspects. China, we realize, is the largest holder of U.S. debt. However, the theory that we're going to stimulate and increase the money supply is predicated upon a domestic economy, not an international one. In theory, you're going to buy back 30-year bonds from those domestically, and that would increase the local money supply and should stimulate. However, nothing happened. The reason is simple. It depends upon who sells it to you. In this case, China said thank you very much, reduced the long-term maturity of their holdings of the United States, and effectively brought their average maturity under 5 years. So what we're looking at is really a global economy, not domestic. This is reflected also when a stock market crashes. The first thing everybody wants to do is start an investigation, find out who caused it, and go after them. But what if the cause is external? They still look for someone domestically to blame. So therefore, government has no power outside the country. So politically, the politicians have to be seen to be doing something. Therefore, they end up needing a domestic person to cause the problem. Now, this is reflected in the sense of Adam Smith's invisible hand, that everyone will act out of their own self-interest. This takes place not only privately among individuals, but also government. Government constantly raises taxes. It never lowers them really. And as a result, that is their self-interest, always to expand their power. Every time the stock market crashes, the SEC, CFTC, they line up to explain why they were unable to do this one. Their regulations never work. Each time they stand up and they claim, well, they would have been successful this time had they had just a little bit more power. So each time we have an economic crisis, they always expand government power. When we're looking at a market, if we understand these concepts that we're dealing with a global economy, then everyone's going to act according to their own self-interest. Let's take a look at gold in Japanese yen. Completely different picture. Here we have gold has been going up sharply. Why? Because it was the Japanese yen that was declining. So in their terms, they're only going to buy gold or sell gold depending upon what it looks like in Japanese yen, not US dollars. They're not taxed in dollars. If you were to invest and made a lot of money, let's say you doubled your money in local currency in Mexico, but then the Mexican peso fell by also 50%, you pay your taxes in dollars. It would be absurd for the government to come in and say, well, you doubled your money in Mexican pesos, so we're going to tax you on that. But then you say, but I lost an equivalent amount of money in the decline in the currency. Oh, we're not going to give you credit for that. So everyone basically responds according to their own currency. That is where they're taxed at. So if they make a profit, it is a profit in their currency, not anyone else's. So when we're looking at gold, for example, the key to having a bull market means something has to be going up in terms of all currencies. If we look at gold in $8, completely different perspective again. If we look at gold in Canadian dollars, similar to the $8. Now let's look at gold in Swiss francs. Here you'll see we have almost a double top. This is reflecting not a single isolated high like we had in 1980. This is warning that eventually gold is going to be making new highs in terms of Swiss francs. Let's look at gold, for example, in British pounds. We don't have the double top. We have more of a slight waterfall. Now let's look at gold in euros. Again, here we have almost a double top, suggesting higher highs are coming. So it depends upon each currency. But if we're going to look at gold, coming back to dollars, we have an interesting perspective that gold is declining, and this is very true, but it's largely not just gold that's declining, it's also the dollar that's rising. So here we have already elected our first monthly bearish reversal in gold. But this is in dollar terms. If we now switch over and look at it in euros, we have not elected any bearish reversals yet. Our first one's down at the 1028 level. So what we have to look at is how a market is going to turn bullish or bearish. We can distinguish easily that gold is going to rise in terms of most other currencies, but decline in dollars. This is what I've been warning about, is that we have the risk of a very strong bull market coming in dollars. Because there's really no place to park big money right now. Europe is a real basket case, and most of the others can't handle very large sums of money. China still has a lot of problems legally, but China will emerge as the largest economy, most likely as early as 2016. But for now, what we have to understand is that gold is in a bearish mode short term. Is it long term? No. But we're looking at gold from many different perspectives. And we have to understand that this is where we are really dealing with. And everyone is going to respond according to their own self-interest. In dollars, we can come back even to this area to retest the old 1980 high. Now, while this looks very impressive, and the nominal rally in gold got everyone all hot and bothered, the problem that we have is that in real terms, adjusted for inflation, this 1980 high in gold is really about $2,300. So gold here has the potential of moving back down to test roughly as far back as about the 905 to 950 area. There is support in here around the 1020 to 1040 area, and initial support is at about the 1150 area. It is more a question of time than just price. But pulling back and retesting the former highs, we're looking at gold most likely turning back up after we see the dollar rally peak, perhaps as late as 2015. Keep in mind that pushing the dollar up is what is necessary to turn the U.S. economy down. That will cause the U.S. current account deficit to increase quite dramatically. It will also cause a lot of the problems in the currency markets, just as in the Great Depression. That was misread by politicians and started protectionism because the dollar rose at that point as well. So what we're looking at this stage in the game is we have to move up sharply in the dollar to put economic pressure to turn things down. Keep in mind that as the dollar begins to rise, we're also going to be seeing rising interest rates. As that happens, this is what is necessary to spark inflation. One of the key issues is that if you honestly do a correlation of interest rates to the economy and the stock market, you will notice that as they decline, we also see a decline in interest rates. When we had confidence largely in the private sector before the Great Depression, all the newspapers were bullish if interest rates went up. Why? Because it showed that people were still borrowing. Interest rates went to virtually zero. No one was willing to borrow. That's not very bullish for the market. Japan, we saw a decline largely for 23 years. So what we need to see is actually rising interest rates. Once that takes place, then the national debts, not just the United States, but globally, will begin to escalate. That is the age of inflation. What we've been going through at this stage has not been the major inflationary area. We are in still the deflationary mode, where governments are raising taxes and the cost of living from a governmental cost has been rising. Unemployment among the youth in Europe is nearly at 60%. So this is not a boom time. This has been largely an effective deflationary mode. The more governments need money, the higher they raise taxes, the less money that there is effectively to spend in the economy, and that is deflationary. So as we look ahead, look for support in gold this year. This is what is necessary. Forget the hyperinflation stuff, because nobody has ever seen hyperinflation in any major economy. The hyperinflation of Germany that they tout was a revolutionary government, and they were communists, inviting the Russian communists to come in and take control of Germany. Nobody would put money in a bank. Why would you? They were basically confiscating all the wealth they possibly could. So we have to look sometimes behind the facts and the rhetoric about history. No major economy has ever gone into hyperinflation. They always turn against their own people and try and hunt down as much money as they possibly can. That is how empires, nations, and city-states always die by their own hand. They commit suicide. And historically, they're all buried in a common grave. So for now, we're in still a deflationary mode, and we're looking for gold to come back down to retest key support areas. Worst case scenario in the mid 900s. After that, we would expect to see gold begin to rise, with most other tangible assets again, but after largely the 2015 period, starting and going in, becoming much more exponential as we see 2017. Thank you very much. I hope this explains what is really going on.